How much home can you afford to purchase with $50,000, $80,000, or even $100,000 of income using an FHA loan? And the reason we're using FHA is because it's one of the most lenient type of loan programs out there. You can qualify with a lot of monthly debt. They'll also technically allow you to go to a 580 credit score, so most people qualify for this type of loan. We'll also go into different income calculations. I'll show you the formulas that lenders use to determine how much you're approved for, so that you can do these formulas as well with me so that you can determine how much home you can afford to purchase if you pay close attention. Now let's get into it. And here's some of the benefits with FHA, and why we're using it is because it's, again, one of the most lenient type of loans out there. They have very flexible guidelines when it comes to this loan. Besides VA has even more flexible guidelines, but it's only for active military and veterans. And FHA, it's not just for first-time homebuyers, it's for anyone as long as you live in the property. And also, if you have major credit events that's happened in the past, like bankruptcy, foreclosures, things like that, FHA waiting period is a lot less versus other types of loans. Also, the minimum down payment is 3.5%. And when it comes to credit score, technically you could go down to a 580 score, but just know you're going to get killed on the rate and the fees, and it's going to be a lot harder approval when you have a lower credit score. So really that next benchmark is going to be a 620. At a 620, you're going to get a lot better rate. So sometimes just making just a little tweaks to your credit, going from high 500s to the 620 mark, makes a huge difference long term. And FHA allows you to qualify with the highest amount of debt, because you can qualify with a lot higher what's called debt to income ratios versus other types of loans. And that just means that they'll allow more of your income to go towards your monthly debt. And here's how FHA compares when it comes to DTI or debt to income ratios versus the other loans. So FHA allows 56% of your monthly income to go towards your monthly debt. Conventional allows 50%. USDA allows 45%, and then VA is one of the highest. It can go anywhere from 50 to 60%. So when you have a pre-approval, that's why your pre-approval amount will be different with different types of loans. So USDA will be the lowest pre-approval amount of all the different types of loans. And here's what gets counted towards your monthly debt from the bank's perspective. So they're going to look at your car payment. They're going to look at your credit card minimum amount that's owed every month. They're going to look at your student loan payment. Also, if you make any child support or alimony payments to someone, if you have any personal loans, that monthly payment as well, and if you have an IRS debt that you're paying on a monthly base. They also include in that the future estimated monthly mortgage payment. Now, what they don't count as monthly debt is going to be things like your rent, your utilities, your gas, groceries, cell phone bills, home insurance, any type of like daycare, child, things like that. Now, what gives the most impact for your liabilities and what gives you the most impact for your overall approval is going to be the debts with the higher monthly payment. Now, it's not the debts with the overall higher balance that you owe. It's broken down and based on monthly payments. So the ones that are giving you really high payments, that's going to bring down your approval amount. And here's the first calculation that we need to do. So we need to break down how much is your monthly income. And before we do that, it's important to understand the difference between gross versus net, because the lenders and the banks look at your gross monthly income, and that's just before taxes are being taken out. Net is your take-home amount. And the formula that you can use that's very simple is you just take your annual income, divide it by 12, because that's 12 months in the year, and that will give you your monthly income. Now, there's a lot more that goes into it with the underwriting perspective. You have different types of breakdown of income, if you're commission, if you're hourly salary, but for this purpose, this is going to give you just the simplest formula to work with. And here's the formulas that lenders use in order to determine what's called your DTI or what's called your debt to income ratio. And this ratio right here determines the entire loan approval. It determines how much you're approved for from an underwriting perspective. So the formula that they use is, number one, they're going to take your total monthly debt. So you want to add up all of your monthly debt, and you want to include an estimated mortgage payment in that as well. Then you're going to divide that by your monthly income. And in order to get that percentage, you're just going to multiply that by 100. So here's the example. So let's say you have $5,000 of monthly debt, including a future mortgage payment into that amount. And let's say you have about $10,000 of monthly income. You divide it, and that gives you 0.5 multiply it by 100, and that gives you 50%. And that just means, again, that 50% of your monthly income can go towards your monthly debt. So with $50,000 of yearly income, you're going to take that monthly amount, multiply it by 56%, because again, with FHA, they allow 56% of our monthly income to go towards our monthly debt. Then that gives us our leftover income. And this amount needs to include all of our monthly debt added up, plus also the future mortgage payment. So then you're going to take that amount and subtract it by how much monthly debt you have. So in this example, we're using $1,000 of monthly debt, and that gives you the amount of the max mortgage payment that you cannot exceed. So with that amount, that includes taxes, insurance, everything out the door. With 3.5% down, that's going to give you an approval amount, the purchase price of the home, anywhere from about $150,000 to $170,000. Now let's go over $80,000. Okay, so with $80,000 of yearly income, you're going to take your monthly income amount, multiply it by 56%, because again, that's the max debt to income ratio FHA will allow. And that's going to give you this amount right here. This is the leftover income, and this has to include all of your monthly debt added up, plus the future mortgage payment. So you're going to take that total amount and subtract it by how much monthly debt you have. In this example, we're using $1,000 of monthly debt. And this right here is the max amount of the mortgage payment that it cannot exceed, including taxes and insurance. So this payment with 3.5% down, that's going to put you for a purchase price around $320,000 to $370,000. Now let's go over $100,000. Okay, so with $100,000 of yearly income, that breaks down to this monthly income right here. Again, you're going to multiply it by 56%, because again, that is the max debt to income ratio FHA will allow. And so the leftover income is about $4,600 a month, and that needs to include all of the monthly debt plus the future mortgage payment as well. And you're going to take that amount, subtract it by the monthly debt. So we're using $1,000 of monthly debt. And this right here, this is the mortgage payment that we cannot exceed. It has to include taxes and insurance as well. So that amount, rough estimate for a purchase price, that's going to put you around a $420,000 to $450,000 purchase price. And here are some key factors that really affects all of these calculations. Number one, it's going to be interest rates, because the lower the interest rates are, really the more that you can qualify for, because it's going to make the mortgage payment a lot cheaper. This is why a lot of people that got pre-approved in 2021 when mortgage rates were in the 2s and the 3s, when we're really low, that didn't end up buying. Then a couple of years later, they decided to get pre-approved, and a lot of people were surprised at how much their pre-approval amount had decreased, even though nothing in their scenario had changed as well. And it's because of interest rates right there. Then two, the down payment can impact how much your buying power is, because the more that you put down, it's going to be the more that you can qualify for. Also, property taxes and homeowners insurance, based on where you live, can alter this as well, because in high cost areas with a high amount of property taxes, a very high amount of homeowners insurance will decrease the amount that you'll be able to get pre-approved, versus if you take that same pre-approval in a different state with a lot lower property taxes and home insurance, because it affects the mortgage payment at the end of the day. And two, when it comes to your debt and your income, the less debt that you have, the more you're going to get approved for. Also, the more income that you have, the more you're going to get approved for. So really that directly affects how much your buying power is. Now, just because the banks allow you to max out your pre-approval amount doesn't make it a smart financial decision for you, because at the end of the day, a lender is not your financial advisor. They work for the banks. And also, the banks really only care about their risk. And that's why they have their guidelines in place, because they want to make sure that at the end of the day, you're going to be making your mortgage payment above all else. And this is how people become house poor, when they take out too much. And the banks don't care about if you're putting away for retirement, if you have enough money for that. They really just care about them getting paid. And so at the end of the day, you know your situation best. Whenever you get pre-approved, have a number in mind that's going to work best for your budget. And here's some budgeting tips. So a lot of financial advisors talk about what's called the 28% rule. And what that basically means is just they advise about 28% of your monthly income should be dedicated or should go towards your housing payment. That gives you a healthy budget. So what you'll want to do is to calculate this amount. You're going to take your monthly income, multiply it by 28%, and that gives you a good idea of where to keep your monthly mortgage payment around for your budget. And if you need a cosigner to help increase that pre-approval amount, That's really the benefit of having a cosigner, is because you can combine income. The more income that you have, the more your buying power would be. And here's some of the qualifications. So whenever you add a cosigner, you must include their monthly debt as well. So the best type of cosigner is one that doesn't have a bunch of monthly debt and brings a good amount of income. Also, their credit score needs to be at least a 620 plus, because even if you have, let's say you yourself, you have a 700 score and you add a cosigner that's at a 620, the banks are going to use the 620 as the determining score. And here's some of the downsides when co-signing with someone. At the end of the day, you're 50-50 owner with them. And at least one of these persons must live in the house. So you must really know, like, and trust your co-signer, because you're going in with half of the ownership with them. And here's how much the down payment and the closing costs can cost. So with the down payment, the minimum is 3.5%, and it's based on the purchase price of the home. Now, what's nice about FHA is that you can get a grant, or you can get a down payment assistance program to help cover this down payment, so you're not having to come out of pocket with it. But it's important to really understand, if you go this route, that you know the stipulation. So make sure if it's a forgivable grant, is it forgivable starting day one, or do you have to live in the property for X amount of years? Or if it's a down payment assistance program, is it more like a deferred loan and I have to pay it back if I ever sell or refinance? These are some of the questions you need to know up front. Now, when it comes to closing costs, it can be anywhere from 2 to 4% of the purchase price, and it's based on a lot of different factors. This is title fees, lender fees, government fees, property taxes, and homeowners insurance. So this is going to change from state to state. And a good strategy to use is the sellers can actually cover all of your closing costs with an FHA loan, and something that you'll need to negotiate up front with a really good realtor. Now, we talked about the benefits of FHA. Here's some of the downsides. So number one, it's really going to be the mortgage insurance, because you're paying mortgage insurance in two ways. Number one, there's an upfront fee. It's a percentage of the loan amount, and it gets added to the loan. So you're financing more. Number two, you also pay for mortgage insurance on a monthly base, and that gets added to your mortgage payment. Conventional, it works a lot differently, because FHA, the mortgage insurance, it stays for the life of the loan. And really the only way to get out of it is to refinance to a conventional loan. Because a conventional loan, if you put less than 20% down, mortgage insurance is still required only on a monthly base. But when you've paid down your loan and you have about 20% of equity, that mortgage insurance automatically drops off. Again, FHA does not work that way. And here's a good strategy to use. So use FHA to get into the home. Then once you've bought the home, work on your credit, or work on whatever needs to happen that prevented you from going a different loan route in the first place. Because you can always refinance later on to a conventional in order to drop that mortgage insurance. And here's how to get pre-approved and to get started. So number one, check your credit score, see where it's at. If it's below a 620, work on a few items to get it up to that amount. Then here are some of the documents that you'll want to start gathering, because they'll need this in order to pre-approve you. If you're an employee, if you work for someone, they're going to need your W-2s for the last 2 years, because you need a 2-year work history. Then they're going to need your last 30 days of pay stubs. Now, if you're self-employed, if you're a contractor, if you're 1099, own a business, they're going to want to see your last 2 years of filed tax returns, because that's where they get your income off of. And here's how to apply for an FHA loan. So number one, you want to work with an approved FHA lender or broker, because FHA does not directly lend to the public. So you can't go to FHA directly. You have to go to a bank, broker, or a lender. And then two, you want to schedule a consult. So at the consult, they're going to be answering questions up front. See if you're ready to go to that next step in order to get pre-approved. And if you're planning to buy a house and you want to know exactly how much buying power you have, click on the link in the description, schedule a call, and I'll help you out.